Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Now, anything can happen at any point in time. And you'll see a lot of activity. Those are the trades that I'm proud of. Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. All right, so this week we're going to talk a little bit about Occidental Petroleum, good old OXY. Warren Buffett's one of his biggest holdings inside his portfolio. Actually, back in June, he added to the position, and we've seen a drop in oil prices precipitously recently. Gas prices, you might have noticed, have came down at the pump a little bit. And once again, we're going to keep the theme that we've had over the last month about bottom fishing. So we're going to try to use options to maybe participate, try to find some stocks that we wouldn't mind buying at a lower price. We've also went in and looked at some, we call them FOMO trades, fear of missing out trades. We looked at a few in Google going into the split, Amazon going into the split. Those stocks have done well after the split, which was real interesting in that the split really didn't have a lot of effect on those stocks. In other words, the actual split adjusted date, the stocks really didn't do much. As a matter of fact, they went down after that date, but now they've been strong after this recent earnings. The markets are struggling. Inventories are an issue. We see that inventories are supposedly getting better, but then we had companies like Caterpillar who came out last week and said that they have strong demand, but supply chain concerns really have tapered their expectations going forward. They can't meet the demands, but the global demand is strong. So we'll start by looking at the trade from last week where we looked at Caterpillar. We looked at a fig leaf in Caterpillar. We took that opportunity of the downturn in the underlying stock, knowing that the fundamentals of the company were still fairly strong. We got the news out in that we had their earnings report. And the CEO came in and said exactly that. Didn't blame it on anything else except for the fact that they couldn't meet the demand. And because of that, the stock really got beaten up. As a matter of fact, it got beaten up even after our show a little bit. So we're going to take the time to go and actually take a quick peek at Caterpillar before we get too far along and see what Caterpillar has done over the last week. And if we look at what happened on last week was 7 days ago, it was the 2nd. Right now we have a 15-minute chart that we're looking at. So this would be, we always tape the show at noon on Tuesday, and we always do it live, so you're dealing with live markets when it's happening. And Caterpillar, in general, after the earnings report, had a big downturn, came all the way up. Right at noon is actually fairly close to where it peaked at. By the end of the day, it was down heavily. Now, because of this, we decided that, yes, we would like to buy a deeper, in the money, longer term option contract to be bullish on a stock like Caterpillar, where your flight to quality is. Bad earnings report, but good good overall comments from the CEO and from the company. And so we decided that because we're down, we're going to buy this call option, but who knows where to buy it, right? The stock was still very volatile on that day. More than likely, we would have liked to have done it on Wednesday, right? Let the stock play out on Tuesday, but we do the stock play of the day on Tuesday. So we bought a deeper in the money call, and then we sold a call against it, which I would have done no matter what, because this volatility that was in the marketplace, you want to try to take advantage of it by selling that call option. And obviously the stock is down. So it's hard to be bullish on a stock when you're on such a big down day. So one way that I don't mind doing that is to, even if I'm buying the stock outright, don't mind buying the stock outright, selling a call against it. We bought a surrogate for the stock. We bought a deep in the money call option, something that acts a lot like the stock, something it was right around an 80 delta, and then sold the shorter term option against it. So what has happened since then? Well, here was the noon call, the noon video that we talked about. Obviously didn't do well as soon as we got off of the video. And then it just has traded sideways for a little bit and slowly started to drift upwards. So the covered call did give us that protection. When we did the trade, the stock was at 188.69. So it was right about here where my crosshairs are. And right now, well, I guess we got dropped off a little bit today, 185.13. We sold a call option for about $1.14, so we can go and take a quick peek at the option chains in Caterpillar. So let me pull those up and get those chains up and running. There they are. Okay, so we went all the way out to the January 20th expiration. We went deeper in the money. So yeah, the stock's at 187.24. So yeah, I knew it was a little closer. So basically flat, considering we made a real big down move after the video on Tuesday. So we'll take 187.24. We're up $1.43 on the day. We're looking at the August 19th when we looked at that call option. We're going to see where that is trading at. Because remember, we went a little bit further out of the money. We got that done for about $1.14 is about where the midpoint was right now. And now it's trading for about 23 to 32 cents. So this was the option contract that we sold. Now, I would consider, if this came down to 15 cents or so, maybe buying it and rolling out a little further in time. We got a good amount of that premium, and part of the reason why is that we sold it on that very volatile day. Implied volatilities were still high. They were off, considering that they announced earnings just prior that day. So they did have the big volatility in that they had the movement in the stock. So we've got a little bit of a vol crunch that has happened and a little bit of time decay. So if this got down to 15 cents, I would consider rolling it out to the next expiration. But that's up to you if you wanted to. Solid right now, made about 70 cents on that option contract that we sold. We're obviously going to be down on the January 20th expiration. So in this instance, we went down to the 160 strike call. So let me add a couple of on the 160s and 175. Okay, give me one more second here. That will do it for sure. There we go. 160. So that option contract was trading at 36.28 approximately. And now it's trading, let's call it, I'll call it 34. Let's make it easy. That's not quite the midpoint, but that's about where we're at. So we're down a couple of bucks on that trade, but our hedge worked because we sold that call option against it, brought in $1. We have 164 days in the January option. We have September and October coming. They're going to be some volatile months. Obviously, there's still tough times ahead. There's a lot of argument if we're in a recession or if we're not in a recession. So basically stay the course. If this option contract did expire and it expired worthless, which looking fairly strong right now, we still got 10 days, anything could happen. Well, I would I would definitely look at going out another 2 weeks and selling another further out of the money call option, so targeting something around 80 cents to $1. So I'd look at whatever strike that is, and I would sell that. Try to bring in some more premium to offset it. Just make sure that we're up enough that we can let our option contract run if we're correct on our forecast. And as always, on the downside, if it ever does come down to our 160 strike, that's kind of our line in the sand. Our option would be an at-the-money option contract. It would have all the juice of an at-the-money option contract, and that's where my concerns would be. I would consider getting out if it came down to that price, and that would be my target. Now, if I'm short the option, I got to buy the shorter-term option back to close and then sell my longer-term call option. But right now, I think you stay the course. You are long the option contract on paper, right? Nothing's meant to be a recommendation. Sold the shorter term option against it, look to sell a couple of more going out to their next earnings. I don't want to be short an option going into earnings, because our whole goal here with the fig leaf is that we really don't want to be assigned because we don't own the underlying stock. So we're just trying to bring in some premium, offset some of the risk, and there's a lot of risk in the marketplace at this point in time. So we're going to keep this theme. Caterpillar already had announced earnings. We were looking at a FOMO, I still would call it a FOMO trade, buying deeper into money option contracts, allowing yourself to participate in some of the upside, but having limited and known risk. And that's the theme that we've had over the last couple of months. So now we're going to go on out. I've been thinking about Occidental Petroleum ever since the news came out that Warren Buffett and his entire conglomerate company, Berkshire Hathaway, decided to up their stake in Occidental Petroleum. Oil has actually gone down since then. It was around $100 a barrel. I think it was actually a little higher than that. Now we see it all the way down to about $90 a barrel. So maybe it might be time to bottom fish in that stock. So we looked at, we're going to be a little bit more bullish in Caterpillar, another strong fundamental stalwart of American ingenuity. And so we bought that deeper in the money option contract. Now we're just going to fish. So I'm going to go and check out my chart on Occidental Petroleum here. Let me pull that one up and get rid of the Caterpillar one. And you can see there's definitely a channel in the underlying stock. So if we go out 6 months in time, this will take us all the way back to that June 23rd date. So this is about when the news was announced on Warren Buffett's purchase. If you see, look at my crosshairs all the way across. There's a lot of activity right around that 55 level. We had the big gap up that took it above 55. This is where Warren Buffett's news hit. And honestly, considering that they did 9.5 billion shares, stock really didn't make a big run up on Warren Buffett news. Usually stocks will take off, but then again, he was just adding to a position. It wasn't like it was a brand new position that he put in his account. So pretty well known that he had it, but obviously confirming that he is still a bull on OXY. And then we had the pullback. This pullback has came because of oil. Had a little bit of a run up today. I thought about Oxy today. I'm a little sad that it made a little bit of a spike up today. But in general, let's see, how would we trade this? How would we bottom fish in OXY? And the strategy that I'm going to choose today, and it's going to be on paper, remember, it's not meant to be a recommendation, is selling a cash secured put. Now, we've done this quite a bit. I think the last one we looked at was a cash secured put in Pfizer. But once again, if you want to look to allocate some capital, this is one way that you can bring in some income in the short term and say, I'm willing to buy at a lower price. So we're going to go down to target. I'd like to target the 55 strike right in that range. But then again, if it did break below 55, I'd be a little bit more nervous. Maybe the 200-day moving average would come into play. But with that said, I'm going to target the 56 level, mainly because there's some premium there. And I really don't want it to break below that 55 level. But we're looking at this as a more longer-term play. We're just targeting the downside, saying we'd be willing to buy 100 shares if it did come down to that level. So here's the cash secured put inside the options playbook. You'll notice that if you actually looked at selling a short put, it has a different graph. Inside the playbook here, I actually put this dotted line because the concept of a cash secured put is that you do want to buy the stock. So you want the stock to come down. You're targeting a buy price below where the current market is at. And you're getting paid for saying, I'm willing to buy 100 shares at that lower price. So once you buy the 100 shares at the lower price, your cost basis we're going to use to purchase the 100 shares. So you're going to lower your cost basis. Your break even is going to be a little bit lower. But you're going to own the stock. And once you own the stock, you have substantial downside, but unlimited upside because you're now long 100 shares of the stock. So it's a different mindset than just selling a put or selling a put spread to say that you don't think the market is going to come down to that level and you're going to speculate and just bring in premium. Okay. Now, if you have any questions, please make sure that you put them in the chat box. I'm going to highlight one last thing here in the rookies corner of my book, the options playbook, selling cash secured puts to buy stocks you want to own. So this strategy is very popular for even beginning option traders. So I did cover it in the rookies corner, and I went into a lot more detail. So if you'd like to, this is your first time considering a cash secured put, you can do them in retirement accounts, anything that has defined risk, as long as you have enough money to buy 100 shares at that strike price. All right, so now let's pause for a second. We're going to run on over to the option chains. All right, and we see that Occidental Petroleum, well, it actually came off a little bit since I was looking at it this morning. It is up 3% today, which is a fairly decent move in the underlying stock. Last is 61.94, so we'll get a little bit more premium, and I kind of like that. Yeah, a few cents more. I'm going to go out 24 days, and earnings isn't going to be until November. That's the only real news event, but there's news around oil and oil prices. There's quite a bit of news, so there at any point in time, OPEC can meet, OPEC can change what they're planning on doing. We have obviously Ukraine and Russia and the conflict there that can change things. So it's still going to be a very volatile marketplace. But we're going to say, well, if it does come down to the 56 level, basically down to the level where Warren Buffett actually added to his position, then we're willing to buy it. We're willing to buy it at that lower price. So here's the strategy. We actually just go over in the right rail. This is where the puts are at. This is where the underlying stock is. Target the 56 strike. We're going to click on that little arrow and we're going to say sell. It puts a sell in there. $1.08 versus $1.12. A very heavily traded good markets in Occidental Petroleum. And that puts it down in our strategy workbench. So this is a very simple trade from this point going forward. I'm just going to hit the little trade button and it will become our official paper trade over in our right rail. We're selling to open one of the September 2nd 56 strike puts, hoping that the underlying stock will come down. We can try to sell it at the midpoint. We'll make it the midpoint at 110, but a 4-cent wide market, so wouldn't mess around with it too much. If I can't get it filled at 110, I'll take the 108. Just a few dollars there to sell one contract a little bit lower. If I sell this, I'm going to have, if I do it in a retirement account, if I do this trade in a retirement account, which means I have to be approved to trade options in it, I need to have $5,600, which means I'm willing to buy 100 shares of stock if it is put to me at the price of $56. But now remember, I'm bringing in a little over $1 in premium, so that once I sell something, I get that cash right away. I can use it to assist in the buying of the shares, or I can do whatever. I can take it out of my account and go to dinner with it if I wanted to. Whatever I want to do, as soon as I sell it, that is in my account, or that cash is in my account, and I can use it to do whatever I would like. All right, so our risk is basically like stock ownership. Below $56, we have substantial risk all the way down to zero. On the upside, the maximum we can make when we sell the put is the premium brought in. But ideally, we're hoping that it comes down to that level. We buy 100 shares, and we basically have the same type of upside as owning 100 shares of the underlying stock. All right. So if you have any questions, please do put them in the chat box. I'm going to run over to the chat box right now, see if we have anything. And right now I don't see any. We still got quite a few people out there just watching. If you have one, I'll give you that opportunity. You can also go back and talk any questions that you want to address about Caterpillar. Wouldn't mind talking about that one. And if not, click subscribe, ring the bell, share this with people. Let them know that we're doing this educational content. We want to get into more. We want to be out here to try to give you situations where you might consider using options as an alternative to just buying stocks outright to enhance your stock portfolio. And that's been our theme for the last couple of months. As a matter of fact, if you're a beginning option trader, you might want to check out my rookie series inside the Ally YouTube channel, Options for Rookies. I have a 3-part, they're each 1 hour long free series that talks about the basics of option contracts in general. And if you'd like to learn more about the educational events here, please follow me on Twitter. My handle is @BrianOverby. And last call for questions. And right now I don't see any popping in. So that's going to be it for this episode of the Stock Play of the Day. Thanks for coming, everyone. We'll see you next Tuesday for the next Stock Play of the Day.